Berkshire Hathaway's board voting unanimously to name Greg Abel as Warren Buffett's successor. Abel will take over as president and CEO of the company starting January 1st of 2026. Buffett's plan to step down after 60 years at the helm was just one of the biggest takeaways from Berkshire Hathaway's annual shareholder meeting. Our next guest, Sam Rowe, he is the Ticker.com editor. He was on the ground this weekend, and we're going to discuss with him. Sam, great to have you here. I love getting your insights. Talk to me about the reaction in the room when Buffett announced that he would in fact be leaving the top position at the company by the end of this year. What did you hear from folks on the ground?
Well, yeah, initially it was stunned silence because, if you listen to his words carefully, he didn't say, I intend to retire. He says, I think it's time for Greg Abel to become CEO. And so your brain has to sort of, make some logical jumps there to say, well, if Buffett's the CEO, then that means Buffett has to retire. So, the wording was really interesting. And yeah, it was stunned silence. But I think, as much as it came to a shock for a lot of people, it's also something that's been in the works for an incredibly long amount of time. First of all, he's 94 years old. You're never going to be surprised to hear when a 94-year-old decides that he's going to not only retire, but retire at the end of the year. And the other thing is the Berkshire succession planning has been one of the most carefully thought out, communicated, transparent processes, maybe in the history of corporate America. We've known that Greg Abel, he became a, vice chair of Berkshire Hathaway, I think in 2018. And so we've known him for a long time. And even in 2021, Buffett and Munger actually announced their intention to elevate Abel to this position. So all that said, of course, when, you've been following someone for 60 years, or, much less for me, and I'm sure you guys too, but like our entire careers, for a lot of people, their entire lifetimes, they've seen him as a fixture at this company, who's also been giving all this wisdom to everybody. So yeah, it's definitely a surprise.
And so, Sam, is there a material difference that we anticipate or expect at all between the trading ideologies as instituted by Warren Buffett and Charlie Munger for decades, for 60 years, versus those of Greg Abel?
Yeah, I think there's two ways to think of this. Inevitably, it's going to change. But that's actually kind of been the history of Berkshire Hathaway and Warren Buffett and Charlie Munger themselves. From a corporate standpoint, the company was founded as a textile company that evolved into an insurance company that evolved into this multi-global conglomerate that also has this big stock portfolio. So that company's business has been changing forever. And then even just strictly from an investment perspective, Buffett started out as this guy who, did quote unquote cigar butt investing, finding extremely undervalued companies and stocks that he believed were trading below their fair value. But then that ideology actually evolved into something that gave him an excuse to buy stocks like Apple. So I think change is actually inherent in this company's culture. That said, again, Abel has been next in line to be CEO for years, and he's actually spoken at the shareholder meetings right next to Buffett. So, if there's a question to be asked now is, well, how much of the past couple of years have actually been determined by Greg Abel's decisions? And I'm sure a lot of it has already.
And Sam, investors were anxious to hear Warren Buffett's commentary specifically on the development of the trade war, which he said trade should not be used as a weapon. And he did say that it is a, quote, act of war. Talk to me about how that impacts your thinking on the impact of the trade war on financial markets as you are writing about the impact of the trade war on financial markets.
Yeah, as blunt as Buffett was when he was talking about trade and trade policy and how it should be implemented, I don't think he actually said anything particularly controversial. Protectionist trade policies is negative for everybody, and especially when you're using it not to advance your economy and not to, build wealth for everybody. But if you're using it as a tool to advance your political interests, then yeah, you're weaponizing trade. And as Buffett said, it can be interpreted as an act of war. Protectionist trade policies hurt economies. So, what happens when you hurt economies? People get unemployed. They can't afford groceries. They can't pay their healthcare bills. Crime goes up. So yeah, it's it's not an act of peace. So maybe it's not surprising when Buffett comes out so clearly and says that it's an act of war. But just so that we're giving Buffett a fair shake here, again, he words things very carefully, and at no point did he actually address specifically Trump and Trump's policies along this way. But he just spoke as a general matter that when you do implement protectionist trade policies and you use trade policy as a tool to advance other interests, it's not a good thing.
All right, Sam, always great to speak with you. Thanks for making the time for us. Appreciate it.
Palantir first quarter earnings just crossed the wires, so let's get you those numbers right now. Palantir's Q1 EPS 13 cents. That is in line with estimates. Revenue up 39% to $884 million. That's versus expectations of $862.9 million. U.S. commercial up 71% to $255 million. That's a beat. U.S. government up 45% to $373 million. That is also a beat. Turning to the forecast, Q2, Palantir saying they're expecting for adjusted income from operations, 401 to 405 million. That's a beat. Revenue, they're calling for between 934 and 938 million. That also best estimates. For the year, they are now raising their forecast. So they're now seeing, with adjusted income from operations, they're now seeing between 1.711 and 1.723 billion. That's a beat. And on revenue, they're now calling for between 3.890 and 3.902 billion. That is also better than expected. I did have the chance to speak with Palantir CEO Alex Karp about the quarter. Let me bring you those comments. Karp saying, this is so improbable unless you have exactly the right product market fit at exactly the right time. And we continue to do this with a paltry go-to-market apparatus. The promise of AI is actually working if you implement it correctly on the battlefield and in U.S. commercial, and you can see it in the numbers. Karp continuing, we have a $1 billion run rate in U.S. commercial now, which is the gold standard for when a company has really broken through. I also did ask Karp about downstream tariff impact, meaning was he seeing any smaller deals or longer sales cycles? Karp saying typically Q1 is our slowest quarter. We don't really start in earnest historically until later in the year. And what do you see in the numbers? 39% growth, 71% U.S. commercial, 45% U.S. government. Where we do see weakness is continental Europe, but that is 10% of our business. I did also ask him what would it mean if there was a U.S. recession? How could that impact Palantir's business? Karp telling us, in the current environment, we are crushing it. The more difficult the environment gets, the more unit economics matter. And the more unit economics matter, the more you have to move to productized software and AI-empowered software, and that is our sweet spot. Finally, I did ask him about Trump's budget proposal for $1 trillion for defense. What would that mean for Palantir? And Karp saying, we are very focused on making America more lethal and in a more efficient way, and we are succeeding with 45% growth in U.S. government. I don't know what the future brings, but we believe we have a completely differentiated set of offerings, Julie.
So the shares have been bouncing around, which is quite interesting when you look at numbers like these. But consider the fact that the shares are up more than 60% just this year alone, at a time when most of the market has not been doing that well, to say the least. It's the best performer in the NASDAQ 100 this year by a wide margin. The best performer in the S&P 500 this year by a wide margin. The trailing price to earnings ratio of this company is in the 600s, which is just mind-boggling, and even on a forward basis is in like the 200s. So in other words, by most conventional valuation metrics, this is a very, very expensive stock.
Well, that has been, a big part of the bearish case, right?
But it keeps going up.
How many analysts have come on, besides, I would say, Dan Ives of Wedbush, who's pounding the table.
Right.
But that has been a big bearish point. That is, the valuation is unsustainable. You had, heading into the print, this stock wasn't more than 60% this year. It's up about 400% over the past 12 months. Right now, stocks, to your point, bouncing around. We're down about 1.5% right now.
So, Jordan, just give us sort of your first blush reaction here to these numbers.
Yeah, thanks for having me today. Well, it's really more of the same. We keep seeing beat after beat. We keep seeing very, very high growth rates, especially in the U.S. commercial business. If we look at how U.S. commercial did this quarter, it's not really a difference in story from the last. If we look at more specifically what their story is here, U.S. commercial has been taking them really past where they were with the government segment for a while. We continue to monitor that. As you mentioned, the valuation here, while we don't take takes on that at Third Bridge, certainly this is what the story has been about. And if you look at why it's been the case, there's really a couple things to think about. The AI market opportunity is big. There's not a lot of pure play vendors that do this, and there's not a lot that you can think might be able to do it consistently in the long term. Now, why has Palantir been performing this way? Well, not only have they been able to execute, as we've seen in this quarter and past quarters as well, but what we've really seen is their ability to execute has demonstrated what many might think is an ability to do so in a sustained manner. And in such a dynamic environment where we have so many startups, so much venture money funding changes in the market on a really monthly basis, there aren't that many players you can say, well, they might actually be able to consistently execute over time. And we see that again this quarter.
And what do you think, Jordan, when you take a step back and look at that sort of mega AI trade trend and theme, what is Palantir doing different in your opinion? What's their advantage?
Yeah, there's a couple of things here. So, we know they cut their teeth in the defense sector for a while. They've been doing this for decades at this point. And they started with really a services intensive business. In some ways, they were not fully just a software business. They've developed a certain level of AI know-how when it comes to actually selling AI. It's a complicated process. You have to identify a use case, you have to figure out how to monetize it, and then you have to put it into production in a customer environment. Initially, that required a lot of consulting know-how, and they developed their product over a long time to be able to make that more efficient and execute on that better. And once generative AI, once we all saw that market boom a couple of years ago, they were able to pivot that tribal knowledge, if you will, into a new product, that being their AIP platform. And we continue to see them execute on selling that product. And that's really the biggest differentiator, that they've been able to do that. And instantiated within that is not just a great product, but it's, again, that tribal knowledge that they have.
Jordan, it's interesting. I was talking to CEO Alex Karp about this. I want his take on a recession. We've had plenty of smart economists, Jordan, come on the show and say they think the probabilities of a U.S. economic downturn have increased. And I asked Karp about that, and he said, listen, bottom line, we're, in his words, crushing it now. The more difficult the environment gets, he said, the more unit economics matter. And the more unit economics matter, the more you have to move to productized software and AI-empowered software. That, he says, is our sweet spot. I'm just curious what you make of that answer.
Yeah, and that's what they've been doing since before ChatGPT even really took the market by storm. They've been trying to scale down this product. And we've talked about this before. They try to scale down a product that's historically very difficult to sell. We're talking, over a year in sales cycles, 10, 15 forward deployed engineers, and you figure out how to turn that into an easy to sell product where you can quickly identify a new use case, bring on a new customer, and then scale from there. And that's the name of the game for software. And they've been doing that clearly. That's what the opportunity is for U.S. commercial. And as we see 70% growth on very tough compares in the U.S. commercial segment, there's really only one way to read that. They've been executing on their ability to deliver that more packaged software solution.
Jordan, thank you. Thanks for your perspective.
Shares of Palantir plunging today. Despite beating expectations in the first quarter and hiking its full-year guidance, the stock's solid quarter seemingly not enough to soothe some fears around the software giant's lofty valuation. Palantir stock has risen more than 60% so far this year. Joining us now to dive further into the most recent quarter, we've got Louis DePalma, who is the William Blair Research Industrials Analyst. Louis, good to have you here with us. There's one kind of major number that a lot of people who are lighting up the Yahoo Finance platform will see, and that's the PE ratio around this stock, which just tells the story about how far run this valuation is still trending right now. I want to get your analysis on that compared to what we heard in the quarter.
Yes, and thanks for having me on the show. In terms of the valuation, you brought up the PE ratio, and quite honestly, it's in the stratosphere, and investors are assuming that the company can maintain 30% or 40% plus growth for the next 5 years with that type of valuation. For some context, the company's valuation trades at 64 times 2026 consensus sales, and CrowdStrike is the second highest name in all of software in terms of its valuation at 18 times sales. So Palantir theoretically could fall by 70%, and it would still be tied as the most expensive name in its entire software peer group. So the stock is not cheap by any stretch, but you are paying for quality here as the results were pristine.
So talk to me about those fundamentals. Obviously, the valuation is of concern, but I know in your notes you said that you also see revenue growth slowing in the second half of this year. You said that the numbers are pristine. Is this the last great Palantir report, at least for this year?
No, we think that there's a potential for the revenue growth to decelerate in the second half of the year or early 2026. However, if the revenue growth decelerates from 39% to 36%, those results are still off the charts. They're still among the best revenue growth in the entire software universe. And then if you combine it with the fact that the company, achieved a 44% operating profit margin, last quarter, and in all likelihood, that's going to continue to trade higher. The run, isn't necessarily done. It's just the fact that since there is no valuation support, the stock could go down while the company continues to execute in a very impressive fashion.
What's a realistic growth rate that investors should expect going forward, and where would those contracts, where would those portfolio clients come from, especially knowing that they have some heavy government exposure, and some governments, especially here in the US, have been looking across where they could cut costs, which was one of the concerns actually for Palantir earlier on, even before Liberation Day?
Great question. We think the growth rate over the long term will probably be more along the lines of the mid-20s versus the most recent 39% in the last quarter. And as it relates to logos, we do extensive government contract analysis. We brand our tracker as the dotted line. And there are several awards in Palantir's pipeline. One award that we discussed in a note is called Next Generation Command and Control, in which Palantir is partnering with L3Harris. There's another award called Golden Dome that Palantir is also likely partnering with L3Harris and Voyager Space and Technologies. There's two awards for DISA. There's an award for Indo-PATCOM called Joint Fires Network. The company has continued to add to its Maven platform. It announced the big deal with NATO. So there's a ton of stuff in the pipeline that should enable the government momentum to continue. And then switching to enterprise, there's a lot of stuff there too.
There certainly is plenty to unpack with this name, Louis. The stock down a little over 8.5%. Thanks for joining us. Appreciate it.
Excellent.
Well, Ford numbers as well, just crossing the wire. Yahoo Finance is Prosper Manian here with the results here.
Yeah, significant impacts from tariffs mean Ford has suspended guidance. Prior to tariffs, Ford said it was tracking within its prior guidance of $7 to $8.5 billion in adjusted EBIT. But now the company sees $1.5 billion in tariff impact on adjusted EBIT, and trade uncertainties making it necessary, Ford says, to pull its guidance, which we've seen Stellantis and others do as well. Now for those first quarter results, Ford posted revenue of $40.7 billion, topping estimates of $36.75 billion, with adjusted EPS coming in at 14 cents, better than the 4-cent loss expected, with adjusted EBIT reaching $1 billion versus the $308 million expected. So in the aftermarket here, we're seeing a little bit of a little flattish trade here right now. I guess people expected this guidance pulled. I had expected maybe a little bit of some numbers there. With GM saying that they were gonna have, they actually reinstated their guidance, but a little bit, they pulled it back a little bit. We're not seeing anything here with Ford, and they claim that as the situation develops, they will then release that updated guidance. But right now, nothing.
And how do we think about this $1.5 billion impact on full year adjusted EBIT compared to what we heard from General Motors in terms of what its costs are going to be?
I mean, General Motors was $4 to $5 billion,
Right.
and I think $2 billion of that, their CFO said, was because of the imports coming in from places like Mexico and Canada, whereas Ford has 80% local production. So that's going to be much more, limited for them. It's good news for Ford. They still have the non-USMCA parts that are going to come in. Those have, a tariff impact. So that's probably where we're seeing a lot of that. They did say they suspended imports from China, which is the Lincoln Nautilus, and they said because we have a big inventory already in the States, so we don't need to import anymore. So they're sort of trying to limit that impact. That number 1.5 versus 4 to 5 that GM has is significant. Absolutely right.
Shares of Ford moved to the downside after the automaker suspended its guidance for the full year, citing uncertainty due to tariffs. While the president limited some of the scope of the tariffs on the auto industry, Ford is still estimating a $1.5 billion hit to its adjusted earnings. Joining us now with more on how Ford is navigating trade policy, Garrett Nelson, CFRA analyst. Garrett, always great to talk to you. Talk to me about that $2.5 billion gross tariff impact number that Ford came to. How are you thinking that they got to that level of impact, especially given about 80% of the vehicles that they're selling in the United States are assembled here?
Sure. Thanks for having me. I think, it's not a surprise that what they guided for in terms of tariff impact was much smaller than GM guided for, $4 to $5 billion. Last week. As you noted, a lot more of Ford's production is in the United States. But I think what you're seeing today, despite this beat that they reported after the bell yesterday, if you look at the full year or the adjusted EBIT that they posted in Q1, it was about $1 billion. But that was pre-April 2nd tariff. The entire quarter was completed before those tariffs went into effect. And so if you annualize that, that only comes to about $4 billion in adjusted EBIT. And of course, the guidance which they suspended for the full year was 7 to 8.5. So, just looking at the results, while Q1 is normally the weakest of the year due to seasonality, the results were still pretty weak, and I think point to some larger issues, taking place at Ford, which we don't think is anything new. So, we think they still have some issues there at the company.
It's really interesting because we heard CEO Jim Farley talk about on the call transforming Ford into a higher growth, higher margin, more capital efficient, more durable business. How much more challenging does that get if you're incurring expenses additive because of tariffs, and then you have to decide which of those you're actually passing through to consumers who are already feeling their own pressure?
Well, I think there's a lot of frustration among investors and shareholders because that same language is the language we've been hearing ever since Farley became CEO of the company in October of 2020. So here we are 4.5 years later, and they're still struggling to drive down costs and create a much stronger company structurally. So
why do you think that is, Garrett?
I just think it's poor management, to be frank. They just haven't done as good a job managing the portfolio as General Motors and others have. Others who are picking up market share in the U.S., such as Toyota, Hyundai, Kia. Ford has lost pretty significant market share over the last 5 to 10 years in the U.S., its core market, where essentially all of its profits come from.
So talk to me then about the degree to which Ford has pricing power versus some of their competitors in the space. They said that their guidance would include price hikes and that they'd adjust their prices based on their competitors. So that makes me think that they're going to wait until somebody else blinks first on lifting prices.
Well, Ford has had a little bit of a rebound in sales. We know their U.S. sales are up 3% year to date. That's through the end of April. So that's a positive. But the big problem in our view right now is that several years back, Ford made a decision to phase out essentially all of their sedan and compact car models. So they produce no passenger cars aside from the Ford Mustang. So it's basically an all truck and SUV portfolio. because of the affordability issue and the pressures that consumers are under. They're struggling. With those big ticket trucks and SUVs. So I think, that's why they've really lost market share and why they've struggled relative to some of their competitors is just the lack of, smaller, more affordable vehicles that are really popular with a lot of consumers right now.
For investors that are trying to figure out and best look out into the future for what the true kind of turnaround story may look like for Ford longer term, what should they be how should they be evaluating the stock price here today and deciding whether or not it's at a point that's worth kind of setting a longer term target for in their own portfolio?
I think the turnaround story largely hinges upon their ability to bring more hybrid models to market. Hybrids are the fastest growing segment of the vehicle market. It's growing even significantly stronger than the pure battery EV market. So, and Ford has had a lot of success with some of their hybrid models, the F-150 hybrid, the hybrid version of the Maverick. So I think it's, if you're positive on the stock, you're looking for a catalyst, it would be Ford bringing more of those hybrid models to market and regaining some of the lost market share. So, I think that that would be part of it. But looking at the stock has been pretty much range bound for the last 3 years. So it's currently trading right near the lower end of the range. However, they have a lot of cash on the balance sheet. They have $27 billion of cash, $45 billion of total liquidity. A nice dividend yield that's yielding about 6%. So it's hard to say that the stock is a short, which is why we have a note out in the aftermath of this earnings release, maintaining our hold rating on the stock.
Garrett, good to see you. Thanks so much for taking the time here breaking down Ford's results.
Thank you.
Shares of Mattel trading higher after reporting quarterly results that beat analysts' expectations. The toy maker did pause its full-year guidance, citing the volatile macroeconomic environment and evolving tariff landscape. Yahoo Finance executive editor Brian Sozzi spoke to Mattel CEO Ynon Kreiz earlier this morning, who said the company is taking action to fully offset tariff costs.
When it comes to tariffs, the mitigating actions that we're taking are designed to fully offset the cost impact, and this includes accelerating diversification of our supply chain and further reducing reliance on China-sourced product, optimizing product sourcing and product mix, and where necessary, taking pricing actions.
Mattel is trading in the red over the past year, pressured by weakening demand from high interest rates, inflation, inventory levels, and now tariff risks. But our next guest says even with tariff concerns, shares are undervalued and attractive. Jamie Katz, who is the Morningstar senior equity analyst, joins me now. Okay, so take us into your thesis around how Mattel can best position itself despite some of the tariff risks that manufacturers and the retail industry are certainly keeping close tabs on.
Yeah, I thought last night's report was really interesting because it was one of the first companies that we heard where we heard the management say, we are going to fully mitigate these incremental costs. And that was quantified to the tune of $270 million, right? So it's not like a small degree. Part of that, I think, is that a lot of investors don't understand that only 20% or so of the inventory coming to the U.S. is coming from China. And as the clip that you had showed prior to our discussion indicated, they are diversifying away from that. So, by 2027, they're only going to have less than 10% of the product coming to the U.S. from China. They are, willing to pull that forward if things stay, the way that they are. But I think there is some flexibility in the supply chain that has been maybe overreacted to. The other piece, I think, is that there is a little bit of a mix shift going on in the product portfolio where they're trying to really wean off products that aren't generating the ROIs that they want. So as you have just a basket of more better performing assets, of course, that's going to help defend your profit margin.
So which products would you like to see and lines of business would you like to see Mattel lean further into versus those that they should start to make some strategic decisions to either sunset or roll back, knowing that consumers haven't been gravitating towards them the same way that they would have now that there's even more digitization, there's even more IP that they would like to leverage in order to create that next either game or toy that's being played with across all generations, perhaps?
Yeah, I mean, I think Hot Wheels has been a terrific evergreen brand for them, and they're coming out with these block sets of classic iconic cars to sort of expand that product line. I think that continues to resonate with consumers really well. You continue to see some issues within that infant and toddler portfolio, and they are continuing to downsize that. And quite frankly, the infant, toddler, preschool category has been, a problem for them over the last decade. So I think they're trying to remedy it. It's just a very difficult age group to tap into successfully for a number of companies, so they're not alone there. And I think for more of the digital part, we've heard them discuss putting out self-published video games. They have a relationship with NetEase, so they are accelerating those avenues for growth. It's just maybe taking a little bit longer than investors might like.
Jamie, I'm going to try and hustle to my finish and squeeze two questions in here. First, what does this all mean for pricing? The CEO told our own Brian Sozzi when it comes to pricing, they work very closely with those retail partners. But it's clear that it's going to have to do some type of moderation on pricing. They assume or they expect to see between 40 to 50% of their product in the US will be priced at $20 or less. What are your anticipations there?
Well, I think they'll probably take pricing in some of the higher priced objects where maybe you're going towards collectors or people with more discretionary income. And then they'll be very tactical in keeping those lower price objects under that $20 price point. So it's accessible for people that are maybe a little bit more stretched right now.
Certainly. And just lastly here, is now the time to consider adding Mattel to the portfolio if an investor doesn't already have it, or is there another more attractive name in the toy space?
Look, I think Mattel and Hasbro are both undervalued. Mattel is trading at about $16 a share. Our fair value estimate's 25. So we think there's a margin of safety. Clearly, if you are very tariff averse, this is going to be a difficult name to get behind, maybe until we get more clarity in July. But the demand is there. It seems like the sales have been coming in. The POS numbers look okay. So we aren't concerned about entry-level price where we're at today.
Joining us right now is Mattel Chairman and CEO Ynon Kreiz. Ynon, always great to get some time with you. So stock is reacting, I think, a little bit better than people would have thought, given some of the things you had to say on that earnings call last night. Top line looked good in the quarter, but a lot of focus on your guidance and the fact that you pulled it. I know you don't take that decision lightly. Why did you have to pull it here?
Well, great to see you, Brian. Let me start by talking about the quarter, which was a strong start of the year with top-line growth, gross margin expansion, and continued operational excellence. We're also off to a strong start in the second quarter with consumer demand up double digits. Our brand portfolio, flexible supply chain, and balance sheet are clear advantages during this uncertain time, and we are maintaining our target of $600 million of share repurchases this year. As it relates to guidance, given the volatile environment and evolving U.S. tariff situation, it is hard to predict consumer spending and our sales in the U.S. In the remainder of the year and the holiday season. So we are pausing guidance until we have sufficient visibility. That said, we are confident about the mitigating actions we are taking, which are designed to fully offset the potential incremental cost impact of tariffs.
And just 3 months ago, Mattel was a company seemingly firing on all cylinders. You were looking for earnings this year, $1.66 to $1.72. Is it fair to say that these tariffs, 145% tariffs, and you make close to a little bit less than 40% of your products in China, that these tariffs would wipe out all of your profits for this year?
What we did say is that when it comes to tariffs, the mitigating actions that we're taking are designed to fully offset the cost impact, and this includes accelerating diversification of our supply chain and further reducing reliance on China-sourced product. optimizing product sourcing and product mix, and where necessary, taking pricing actions. In terms of the tariff impact, what we said on the call is that the potential impact, assuming current tariffs, the incremental cost exposure this year will be $270 million, but this does not include any mitigating actions or offsets. And as I said, we're confident in our mitigation actions, which are designed to fully offset the incremental cost impact.
And on how much will toy prices go up this year because of tariffs from a Mattel perspective?
When it comes to pricing, we work very closely with our retail partners. We always have the consumer in mind and make sure that we offer great product with the right balance of quality and value at affordable price points. We take a strategic approach, and under the tariff scenario that we see today, we assume or we expect that between 40 to 50% of our product in the US will be priced at $20 or less. I'll give you just a couple of examples. Hot Wheels basic car, the #1 toy item in the world, we sell for just over $1. And an Uno pack, the #1 selling card game in the world, we sell for about $6. So our diversified and flexible supply chain is a clear advantage for Mattel that will help us keep prices affordable for consumers in this period of uncertainty.
Now, a new report out of the Toy Association, they're saying about 50% of small and mid-sized toy businesses could go out of business within weeks, if not months, because of these tariffs. We'd love to get your thoughts on that.
Yeah, look, there's no question that tariffs are creating a real disruption in the industry. And as you said, 80% of toy production globally is from China. And many companies are very exposed. Some companies make 100% of their production in China. So companies have stopped production and shipping to the US as a result of tariff on China. We do support the Toy Association advocacy for zero tariffs on toys to ensure that safe and affordable product remains accessible for everyone, given that toys are such an essential part of children's lives. For Mattel, it is a very different situation, given our scale, brand portfolio, and diversified and flexible supply chain, and that we index at less than half of industry average of product coming from China. In terms of US imports, less than 20% of our global production come from China, and we plan to reduce that below 15% in 2026 and below 10% by 2027, with additional contingency plans to accelerate that if required. So we expect not only to manage through this volatile period, but to strengthen our competitive position and as our standing as a trusted partner for retailers and consumers.
Now, I have to tell you this, and I don't say this lightly. I talk to other toy manufacturers, and this tariff situation has been a punch to the gut for them. It fundamentally changes how the toy business runs. Are we looking here at potential toy makers just shipping products, a doll with no hair, a doll with no arm, a doll missing fingers here, because now these products can't be made at a profit in China? What's the end game here?
Look, at Mattel, we are committed to the uninterrupted supply of quality products at a wide range of affordable price points to children and families around the world. This is what we do. We are very good at managing complexities, and we are ready for the challenge.
And lastly, Anand, I'm sure you saw the president's comments saying that maybe in this land of tariffs, children would have to go with maybe 2 dolls instead of 30. If you were sitting next to the president, what would you tell him about a comment like that?
Well, we all know the importance of toys in children's lives and how much toys make a real difference in a child development. At Mattel, we create innovative products and experiences that inspire fans, entertain audiences, and develop children through play. And we are very committed to this mission. always having the consumer in mind.
DraftKings missing first quarter expectations and cutting its full year revenue forecast. Still, revenue rose 20% from a year ago. The sports betting company says a lack of March Madness upsets kept it from raising its 2025 guidance. Joining me now, Jason Robbins, DraftKings CEO, and my Morning Brief co-host, Brad Smith. Jason, thank you for being here this morning. Let's start on the guidance. I'm really interested in getting some clarity from you on this. You said you would have raised it if not for unusually customer-friendly outcomes during March Madness. Can you break that down for us? Should investors just always expect your guidance to be driven by game outcomes?
Well, not always. I think in this case, we had a pretty historic March Madness. It was only the second time ever that all 4 number 1 seeds made the Final Four. And in addition to that, the first time ever that happened. And you had 3 number 2 and 1 number 3 seed in the Elite 8. So really a tournament where favorites were winning. 82%, in fact, of the favorites won. So that was actually an all-time record for March Madness. So I think it was a bit of an anomaly. We've heard theories like NIL may be driving more of that type of thing in the future. So obviously the models will have to take those sorts of things into account. But I don't expect that kind of favorite run to happen most years in March Madness or in any sport for that matter. But it does happen sometimes, which is part of the great aspect of the product. Customers can really go on winning streaks on things like that, which is great.
So then let's talk about what you are anticipating regardless of game outcomes, especially for the next year here. Sales and EBITDA for Q1 did miss consensus in part due to gaming taxes, among other potential headwinds among a macro uncertain environment here. How are you thinking about the health of the consumer and the impact that could have on your business in the quarters to come?
Well, we included some material on this, and because we knew this was a question on investors' minds, we included some material on this in our earnings release. And it's pretty clear that gaming and online gaming has also really shown resiliency through macroeconomic downturns. We took some data from 2008, the Great Recession, and we saw that obviously didn't have U.S. online gaming at the time, but it was widespread throughout Europe, and it grew quite nicely through that period. So that, in addition to us looking at our own metrics and seeing very healthy customer metrics across the board, and we analyze everything, really gives us confidence that we are pretty resilient to any economic environment.
With that in mind, how's that factoring into the guide right now, Jason? And great to speak with you again, especially as we're in this period where we've heard TV ratings are strong for the NBA playoffs right now. How's that flowing through to DraftKings?
Well, strong ratings usually lead to betting and vice versa, so those are good things for us, and hopefully that'll continue. The NBA playoffs obviously has been off to a fantastic start with these games, lots of great close games. My Celtics haven't come out on top so far, but still have a lot of way to go, so we'll see. But really, it's been a great quality product as we expected, and the betting is following.
As a Philadelphia fan who lives in New York, it's been quite rough for me as well, Jason. So I somewhat share your sentiments.
I can imagine.
There. So all things considered, as you're thinking through the sports events over the summer that are going to be the key drivers for DraftKings business, as we're now in a summer that is going to be Olympic-less, but still potentially have some other major catalysts for the business, what would be those key drivers from how you're looking out into the next 3 to 6 months?
Well, obviously, baseball is a big deal during the summer. It's our biggest sport. We were really happy to see that in April, baseball was up 16% on handle year over year. Live handle was up 36% year over year. So really strong metrics on both fronts. So hopefully that'll continue through the summer. We also have a lot of great enhancements we made to our golf products, our MMA, UFC products, and many other sports that'll be occurring during the summer as well. So definitely not the most active time of year from a sporting perspective, but still a lot going on the sport calendar, and we're seeing great customer metrics.
One thing I'm just personally interested in as a markets nerd more than a sports one, Jason, is whether or not the market volatility that we saw over the last quarter is a potential headwind for your business. In the Venn diagram of sports fans that are also interested in financial markets, does market volatility that encourages some riskier investing behavior like options trading, for example, prevent you from having those customers be more active on your platform?
We haven't really seen that. It's something that we talked about. I do think there's a bit of a difference, even though I'm sure there's some overlap in the customer. There is a different segment that I think is more into that. But certainly, it's something that we are keeping in mind. And, anytime regardless of the reason that a customer has less discretionary entertainment income, that's always a factor. And I think, you can look at that across the board. But again, for us, we've really not seen, and nor has the industry ever seen, any of the macroeconomic factors out there affecting the numbers. It's always been pretty resilient to any kind of economic downturn. So I don't really expect that to be play out differently here, but it's something that, of course, we'll keep an eye on.
And I want to go back to the tax question that I mentioned earlier. Have you had any conversations with legislators over the past quarter here about what any changes to tax regulation in particular could look like going forward for the business?
Well, we're operational now in almost 30 states, so there's always going to be some of that going on in any state. We're obviously educating and helping understand that there's still an illegal market out there. There's still other options like federally regulated prediction markets. So we have to be taxed fairly if we're going to be competitive, and I think most states understand that.
As you're thinking about your average revenue per user right now, and ultimately $108 in the first quarter of 2025, 5% actually decrease compared to the same period in 2024, where do you see the opportunities to extract more values on a per user basis, knowing that users are, as Maddie was saying, being more discerning or looking across their spending and their finances and trying to figure out, how much do I actually realistically have to gamble or continuously wager versus a period where they might have a little bit more discretionary dollars?
Well, the reason that it was down was really those sport outcomes. And, that just means customers were winning, which I think is a good thing for long-term health. If you look at our handle, as we noted in our call, we were up 16% year over year, which is the amount of money wagered. So that's something that we look at more in terms of the overall spend of the customer. Obviously, outcomes can happen, and that can drag down, if you have a quarter like that, the average revenue. But those quarters, even though we've had 2 in a row now, they tend to be more of an anomaly. We haven't had a string of 2 quarters like that ever before this. So, great thing that customers were able to win, but also over time, those metrics will normalize. And we're really looking at the fundamental customer metrics, like how often are people playing? What does retention look like? How much are they spending?
And I know in the past you've talked about how sports gambling is not an investment tool, but I wonder how you think about sports betting as an investment tool going forward. Do you see this as a market for investors to really and potentially gain some revenue in their personal lives moving forward?
No, I don't think at all. I think it's an entertainment product, and people who bet don't expect to win over the long term. I think that there will be streaks like this where certainly there are customers that will make a lot of money, and that's a good thing. But I don't think people should look at it at all, and certainly don't as a long-term investment tool. Certainly it's an entertainment product.
All right, Jason, thank you so much for making the time for us this morning. Jason Robbins, DraftKings CEO, and our own Brad Smith for the conversation as well. Take a look at one stock we are watching at the market open here, and that is Texas Roadhouse. Shares are higher, up over 5% after the company posted mixed earnings for the first quarter with lower than expected earnings, but a 3.5% increase in same-store sales. On the earnings call, leadership acknowledged some of the macro headwinds, including consumer sentiment and, of course, tariffs. The comments echo concerns voiced by other companies like McDonald's, which said they were not immune to industry volatility. Chipotle on its call saying consumers reduced restaurant visits due to e-com concerns. Joining us now on this, John Towers, Citi's restaurant analyst, to break down how consumer demand is impacting the sector. John, it's always great to get your insights. Before we get into the individual companies here, I just want to get your macro take on the sector and on the health of the consumer. How would you describe how the consumer is holding up amid the macro uncertainty right now?
I think fairly well. I mean, we had a really noisy first quarter with weather really being a significant factor, and then March, and then April came along, caused a lot of noise for consumers. Confidence fell quite a bit during the month, and I think that caused a lot of folks to pull back, at least temporarily. But we're also hearing from a number of companies that April actually improved relative to what they were seeing, certainly during February, March. So it's a bit of a mixed bag. I'm not all that concerned on the health of the consumer at the moment. And look, I don't know where we're going to go from the U.S. economy standpoint, but if we do go to a slowdown, I think the restaurant category is actually set up relatively well to outperform other parts of consumer discretionary.
When you hear this number of businesses talking about remaining focused on the fundamentals of our business, things they can control? What are the main controllables, the variables that are a little bit more in their hands that they can essentially kind of pull levers here and there to ensure that they do navigate what is an uncertain environment that all of them have acknowledged in some capacity or another?
It's great value, great service. It's relevant products. It's staying in front of the guests with good news, meaning, you're staying out there with important or relevant products, right? You're not just saying, here's a value price point. It's here's a value price point with new product news behind it. And it's high quality food, right? And you're getting it in an environment that you want to be in. It's not a tired restaurant with poor service. It's, frankly, a waiter or waitress coming up to you and saying, hey, how you doing? And I hope you're having a great day. And oh, by the way, we're coming to your table more often to make sure that your drinks are topped off. You're getting what you want. It's really those soft touches that will drive customers back to the store rather than, eating at home or going to a competitor. So I think all of those, it's really soft things, but they matter in times when consumers are pulling back.
And so within that, some people will hear value and read through to say, well, it sounds like more promotions as well. To what extent then do some of those promotions start to hit the margins?
Yeah, I think a lot of the operators have gotten smarter about how they promote, when they promote, and value engineering any sort of promotion that they put forth to the guest. So it's not just straight discounting. It's ensuring that whatever they put forth on their menu, they're making some profits, not only clearly for the company itself, but in a franchise model, ensuring that their franchisee profitability is not, falling in the tank. So everything that you're going to see out there might, decrease profit dollars modestly, but they're also hoping that it drives traffic to the store. And then when a guest comes through, they're adding, say, a beverage to the occasion, adding a side item that they wouldn't have done had they not come to the store in general. So it's much more thoughtful than it used to be, say, even thinking back to the financial crisis when there was a lot of panic setting in across the industry and there was just straight discounting to get guests in the door. This is a much more methodical industry, much more analytics behind it. So I do think that as we see promoting come through, more discounting come through, it's not just straight up discount, unprofitable. It's more thoughtful and profitable promotions.
John, thanks so much for taking the time here with us today just after the opening bell. Appreciate it.
Good to see you. Thank you.
Coinbase's quarterly results falling short of expectations as the company feels the effects of volatile swings in the price of cryptocurrencies. But with Bitcoin back above $100,000, could next quarter see a boost? Joining us now, Devin Ryan, Citizens Director of Financial Technology Research. Devin, great to have you. So Bitcoin back above that $100,000 level. To what extent do you continue to see the price of Bitcoin impacting crypto stocks like Coinbase?
Hey, good morning. Thanks for having me on. So it absolutely matters because it affects sentiment on the group. And so the first quarter was, obviously a little bit of a risk off as the quarter progressed, and you saw crypto prices coming down a bit. What you've seen just over the past, a little bit over a week here at the beginning of May, crypto market cap's up over 10%, and you're seeing pretty strong re-engagement in trading. So a little bit of a lighter trading quarter in the first quarter for Coinbase. Second quarter has started also relatively slow. April with the tariffs kind of risk off month, and then the tone here just even in recent days has been quite a bit better. So we're looking for kind of a better second half of the quarter relative to the first half. And then the bigger picture here is Coinbase is focusing on what it can control and really building out a much more diversified business model that we think can last through kind of crypto volatility over any short period of time.
What do you think is the largest growth engine for their business right now, Devin?
Well, today it's still trading, but what I would say, and this kind of gets lost, I think, in some of the noise, is that the subscription and services part of the business, which is nearly $3 billion run rate right now, is again, it's about a third of revenues. It didn't even exist 5 years ago. So you now have a $3 billion business, and that part of the business is going to grow rapidly. That's where they are helping Circle, their partner, expand stablecoin utilization. We expect stablecoins are going to grow by more than 10x by 2030. So kind of an explosion there and a big opportunity, staking and then crypto kind of as a service, where Coinbase is really, as more people come into this ecosystem, which is happening now, but it's really going to happen on the other side of stablecoin legislation and market structure legislation. Coinbase is going to be in the middle of all of that, whether it's tokenization or helping firms get into the industry. And so that's going to be a big future opportunity for Coinbase. It's not, it's growing, but it's not moving the needle as much as it will in the future.
Yeah, and you mentioned in your note that management is still hopeful on legislative progress going forward. But of course, as you know, there was a bit of a scuttle to that this week when Democrats did not move forward legislation that is GOP-led that would be favorable to cryptocurrencies in particular. Are you concerned about that legislation leading to a broader headwind for cryptocurrencies, or do you think this is just a bump in the road?
Yeah, so great question. We're obviously watching closely, but our sense is right now this is more negotiation and the path is still forward. So there's just been such bipartisan, I think, support over the past really 6 months as people realize this is a critical issue for the American public. It was a key kind of winning point for the past election that we just had here, and not just at the presidential level, but across Congress. And so we think that we're still moving in a positive direction. We're watching it closely, but I think that kind of the vote yesterday was just more negotiation tactics relative to some big halt in progress.
And so, what would holders of crypto truly like to see in not just the establishment of the strategic Bitcoin reserve, but actual either purchasing or adding to the pile that already exists of excess of 200,000 Bitcoin, which I believe we're still the largest country or nation holder of Bitcoin right now?
Yeah, so I think there's two things. There's obviously Bitcoin, and Bitcoin, kind of this digital gold asset that has been growing kind of through the ups and downs of the market over the past decade plus. And I think that is something that people feel very strongly about continuing. And then you have kind of added fuel to the fire, whether it's the strategic reserve or the ETFs, which we think are still in the early days and will have much more demand over the next couple of years. And then now you have all these corporate treasuries stepping in as well. And so that, in our opinion, will support much higher prices over time. And so I think people are looking at that tactically, either from a trading perspective or just they own Bitcoin and they're going to hold it for a long time as digital gold. The flip side is you look at all these other tens of thousands of digital assets, they're serving very different purposes, some of which we think have a very bright long-term future as a blockchain that will be utilized, and some are much more speculative. And I think what we all want to get to is a place where we see the utility of the blockchains, and that's going to drive value over the long term.
Lyft shares driving higher after the ride-sharing company reported better than expected gross bookings for its first quarter. Lyft's results a contrast to rival Uber, whose gross bookings fell short in the most recent quarter. Here to discuss Lyft's results is CEO David Risher, alongside our executive editor Brian Sozzi. David, great to speak with you. Thank you for making time for us this morning. It's really interesting to look at your results, especially when compared to your competitor Uber here. What do you think that Lyft was able to do over the course of the quarter and over the course of your several years here now as CEO to outrun your competitor?
Obsess over our customers. It's just that. I worked for Jeff Bezos for a long time, and he really taught me the importance of looking super closely, figuring out exactly what your riders and drivers, in our case, want, and just really overdoing it to give it to them. And our service levels have never been better. We're doing all sorts of great things for drivers. I'll give you one statistic. We now have a 23 percentage point advantage over the other guy in terms of driver preference. And that's because we treat drivers well and they deliver great service.
David, one of the things that we've continued to track across the travel industry, and especially in our conversations with airline CEOs over the course of this quarter and results, is the uncertainty in their outlooks, and how that could potentially be passing through even to the ride sharing is something that investors I know have been paying close attention to. What are some of the trends that you're seeing just around those hubs as it's kind of passed through to the Lyft business?
Yeah, it's so interesting. And of course, everyone's very interested in this, and I understand why. The truth is, we haven't seen anything to be concerned about. And I'll give you a couple of examples. Let's look, for example, at our last week in March. It was our best week ever in terms of ride volume. Let's look at Cinco de Mayo, which just happened just last week. Super strong, really nothing going on there. Even airports, I mean, it's true, as we said last time, airports been just a tiny bit on the softer side, but honestly, it's so small as to be almost negligible. And of course, in our business, the bigger question is, how can we get, right now, only about 20% of people take rideshare to the airport. Where are the other 80%? So I'm more focused on the big opportunity right there. Honestly, haven't seen much to be concerned about in terms of consumer sentiment.
David, good to see you as always here. Like Brad was mentioning, look, the economy slowed down the first quarter, but it's still a competitive market for talent. Really curious on what you think about, a lot of the feedback, to say it lightly, that Dara at Uber's getting for getting his employees back to the office 3 days a week. And then secondarily, what's your return to work plan?
Sure. So hey Brad, good to see you. I, joined in this seat a couple of years ago, almost 2 years and I think 2 weeks ago. And one of the first things I did is told our employees that we're going to be back in the office 3 days a week. So, we've really been ahead of this. Our focus has been on really obsessing over customers. And as you know, our purpose is to serve and connect, And it's really hard to do that if you're all sitting around, sort of being isolated at home. I have all sorts of things to say about societies when they get isolated. I don't think it's very good for society. And I think it's great for business when you get people back in the office. So that's what we've done.
Well, clearly, you've gained, it seems like you're gaining the competitive edge against your other guy, as you mentioned. Do you want to go to 5 days a week? Do you think that really helps you go farther ahead of what Uber's doing? They had 2 days, David. Why not go to 5 and really take it to them, man?
You know what? I don't think that's what we're going to fight over. I think, look, I'm going to do a pivot. This is what CEOs do. And I'm going to talk about a new feature that we've just launched called Lyft Silver, which is all about getting older folks, out and about and making sure they live their best lives. That's the type of feature that you really get when you obsess over your customers, when you focus on what it is that they want. And whether you do it 3 days a week or 5 days a week in the office is sort of secondary to really focusing on what it is your riders and drivers want.
Well, I think back when you first started, David, I think we talked to you pretty much right when it happened. You had to make a lot of tough decisions out of the gate. Would you just simply say, it is what it is? Or do you have to have now in this environment, you have to have more compassion for your workforce?
I think you have to have some compassion for your workforce. I really do. Look, here's something that we know. People do their best work when they feel supported. People do their most creative work when they're together bouncing ideas off of each other. But honestly, people also have complicated lives. They've got kids to deal with. They've got babysitters. They've got moms they've got to, attend to as they age. So, I think we've got the right, it's a hybrid strategy. I think it works really well for us.
I want to go back to a little bit of the balance sheet here, Brian, because because one of the things that you point out that I think is really interesting is the obsession with the customer. And part of the way you've obsessed over the customer is keeping prices low to eke up market share from your competitors. How do you continue to do that in an environment that's increasingly competitive and increasingly hearing from analysts that they want you to continue pouring cash back into the company through things like the buybacks you announced versus keeping prices lower for customers?
Yeah, it's not a trade-off. You have to do both. And so again, you have to start with the customer. And I'll give you an example of something that we've done. We've talked about it in the past, which is Price Lock. Price Lock is a way for any rider who wants to, who does a daily, kind of commute or something that has the same route over and over again, to lock in a price. So they don't have to deal with all the surge pricing baloney that somehow the rideshare industry has convinced people is okay. We don't think it's okay. We're trying to get rid of it as much as we can, and that's our mechanism. That's a product that's increased every single quarter since we've launched it. We have very high retention rates, 75%. So really good growth there. So that's an example of how you can do right by your customer, give them an affordable product, and in this case, a reliable product. And at the same time, as you mentioned, Madison, we generated $920 million in cash over the last 12 months. So we figured out a way to do both, and that's going to be the way we continue to grow as a business.
David, I was just at the Milken conference out in California, and I was walking back to the hotel with an $8 Starbucks coffee, and out passes me this Waymo driving past me with nobody driving in the car and somebody in the back. I'm like, well, that is some weird stuff. Why are you launching autonomous vehicles in Atlanta? Does the world really need this stuff?
Does the world need it? Well, okay, it's a great starting point. Are you building technology just to build it, or are you building it because people actually want it? Here's what I'll say about autonomous vehicles. They're going to be an enormously important and I think positive addition, to sort of our transportation infrastructure. Why? Because they are safe. Not only do they know the rules of the road, they follow the rules of the road. And over time, that's going to just expand the market for people being driven by something else. Sometimes drivers, sometimes robots, fine. As you said, we're launching in Atlanta in a couple of months with our partner May Mobility. Super excited about that. Honestly, it'll be at a small scale. You have to step into this. This is going to take years and years and years and years to kind of get right and to get great. But I'm excited about it. I think it's actually going to open up new opportunities. And at the same time, I have to say, there are a lot of people who are going to want to be driven by, a great driver who maybe helps with your luggage, maybe even asks you how your day is going if you're having a tough day. So I'm kind of excited about the sort of hybrid future of autonomous and human drivers.
David, only got 30 seconds here, but for the cost, the operating cost per mile for Lyft's business in the future, when you expand this and scale it up, what does that look like in terms of bringing that cost down?
Well, are you referring to autonomous or more generally? I mean, we're always looking. Yeah, sure. I mean, of course, like any business, we're trying to lower our costs. When you think about autonomous, you might think, of course, that the cost will be lower because you don't have to pay a driver. On the other hand, insurance is a bit of unknown. Repairs and maintenance are a bit of unknown. So, of course, if that happens, we'll be excited about it. It'll allow us to offer to more people. But it's going to be years out before I think cost is really a significant part of the equation.
David, thanks so much for taking the time here with us today.
For sure. Enjoyed it. Thanks, y'all.
Topping first quarter earnings expectations, the rideshare company highlighting record first quarter gross bookings. Lyft also lifting its share repurchase program to $750 million. Rohit Kulkarni, Roth MKM Managing Director, Senior Research Analyst, joins us now to discuss. Rohit, always good to see you. So Lyft reports that stock is rallying in the after hours. Walk us through your reaction, your response to what that report said, Rohit.
Hey, thanks, Josh. I think after Uber reported, after Dash reported, I think the expectations for Lyft were not that heroic in a way that people were a little bit cautious. I was a little bit cautious in a way that perhaps second quarter guidance is something that they may not be able to provide that would be very encouraging. What is the biggest positive in all of this is the number of rides. The number of rides that people take on Lyft, that's the actual kind of a metric that we track outside of bookings, outside of revenue. And that is probably the healthiest we have seen in a while, both in 1Q and both what they expect in 2Q, mid-teens growth. So I feel the moment kind of the marketplace starts to function very well, rides grow, and that's what we are seeing in Lyft.
Rohit, the conference call is going to start shortly here, 5 p.m. Eastern. If you had the chance to ask an executive a question or two, what would be top of mind for you?
Again, it's the obligatory question about how have trends changed in March and April as compared to what your normal patterns have been. That's your tariff question, macro question, whatnot. Leaving that aside, I think what I would love to learn is how sustainable is the current growth, and with all the new products, the new drivers that you have on the platform, how confident do they feel into the second half of this year that they can sustain this mid-teens growth rate, which then would imply that Lyft is probably a profitable company for the first time in the history of Lyft.
Now, Rohit, though, you're still neutral on this name. So walk us through, why are you still on the sidelines, and what would you need to see before getting more bullish?
I think from a ratings perspective and a stock call perspective, I think what we need to see is, again, baby steps which are very consistent. I think this is the first time in quite a while, to be honest, Josh, that Lyft has reported 2 quarters that have been consistent, which is a positive step in the right direction. Unfortunately, as a small company, as a company that does not decide the price of its service, it tends to have extreme volatility. So you may have one good quarter, second bad quarter, third good quarter. So there is no consistency. So for us to have a more medium to long-term conviction in the stock, in the company, I think we just need consistency. And I think we are starting to see signs of that.
What about their recent decision, Rohit? They announced this decision to acquire FreeNow, which would give them a foothold in Europe. Did you like that decision, Rohit, strategically and financially?
It remains to be seen. As in, I think it feels that acquisitions is the next leg in growth for almost every company like Uber, like DoorDash, like Lyft. Uber acquired a company in Turkey. DoorDash acquired a couple of companies recently, and Lyft is doing the same. So I feel there is now these companies are at a point where they are profitable enough. They are generating sufficient amount of cash, and now they can start to do consolidation. Lyft has always been 90% US, 10% Canada, and now I think they feel that there are pockets in Europe that they can be a number 2, number 3 player behind Uber to start to grow that addressable market. So its verdict still out. We like the acquisition, but how they execute on it remains to be seen.
You know, David Risher became CEO in April 2023, so 2 years on the job now. You've covered this company, you know this company. I'm just curious to get your take, of the job he's done.
I would give him 4 out of 5 stars. By that, what I mean is I think he has turned around the company and has created a narrative amongst investors in a way that is extremely encouraging. Now, the proof would be in the numbers that they put up on a quarter-over-quarter basis. But overall, from a cost structure, from a product, from an execution, from operations, and overall from a narrative standpoint, I think he has done a fantastic job. Now, all we need to see is consistent execution. Last 2 years have been almost like preparing for the moment of today or over the next 6 months. Hopefully, they can execute on what they have built in the last 2 years.
Mark, I'm sure you're still sifting through the results, but I know you're a bull on this name here. But I am curious what you make of that revenue miss.
Yeah, well, first of all, thanks for having me. The miss is, in the big picture, really inconsequential, especially relative to today's news, where the company announced the largest acquisition in the history of the digital asset industry, and positioned itself to be an even bigger player among institutional investors. So what we're seeing right now in terms of the top line, and particularly subscription and services revenue, that is point in time. What we are thinking about is where are these numbers going to go once Deribit is actually part of the Coinbase family, and that's what's really exciting. So right now, if you look at subscription services, you've got custody, you've got staking, you've got the contribution of stable coins, but derivatives is really not a big part of that. And if we see the kind of institutional adoption of crypto that we are anticipating, a lot of those institutional players want to express their views in crypto via derivatives. And so now Coinbase via Deribit, which is the largest player globally, is in a great position to do exactly that.
And Mark, I know, though, you make a beeline, as so many do, for that subscription and services revenue number. So the fact that in Q1 it did come in a touch light, 698, consensus was 702.5, that's not a concern for you?
No, it really isn't. Especially, the trading volume side, we have the ability to track. Any analyst can track that on a daily basis. The reason why subscription and services revenue is so important is because the company is trying to become less dependent on particularly retail transaction revenue. And so the more that it can grow that number, the better. But again, this is a work in progress. If we are able to see the U.S. Congress pass and enact a market structure bill such that there's a regulatory framework and institutions feel much more comfortable participating in the crypto space, then the numbers with regard to staking, for example, custody, and now derivatives are likely to be much, much higher. So this, in our view, is really not about where they were as of March 31st, what happened in the first quarter of 2025. It's about where do we go from here. And there are some pretty exciting things on that front, especially, again, if we see that legislation passed so that everybody knows what the rules of the road are going to look like going forward.
At the same time, Mark, Coinbase still operates in the world that we all operate in, and it's a world where there are a lot of question marks right now, and they refer to that in their letter. They say macro uncertainty, including around global trade policy, is impacting consumer sentiment and may contribute to softer crypto trading markets and lower asset prices as we enter the second quarter. And I think that's been one of the interesting things during this first stretch of the year for underlying crypto prices, right, is that it wasn't a safe haven. Gold was the actual safe haven. The old school safe haven was the safe haven. And so how then does that affect Coinbase if there is more risk in the market and if it hits crypto prices?
Well, I think it's pretty clear, based on what we've seen recently, that the macro is still very much a factor as it pertains to all things crypto. With that said, it is pretty impressive that with the kind of market and macro uncertainty we still see right now, Bitcoin today surpassed 100,000 for the first time since January 20th. And so, clearly there is a bid there, just between two of the big players, BlackRock being one and Strategy, the former MicroStrategy, being another. They're buying up quite a bit more than the amount of Bitcoin that's produced in a given day. So the demand side is there, and we have not even gotten to the point at which institutions have seen the green light to really participate. So yes, the macro is going to be a concern. We saw that hit Coinbase shares over the last couple of months. But at the same time, the setup here going into the back half of 2025, in terms of the legislative initiatives, in terms of the potential to have institutions get involved in earnest for the first time, because of course, crypto is that odd asset class where retail investors have led the way in terms of adoption since crypto's been around for the last 15, 16 years. You bring the institutions into play, and the first step was really, the fact that the SEC approved in the U.S. Bitcoin spot ETFs. With that in place, we've seen 140 billion of those now. The next step is allowing institutions to feel comfortable entering into the space. And again, the way that these institutions typically want to express a view is via derivatives. And as of today, Coinbase is now in a position to be the leader in that space. That deal is supposed to close at the end of this year. So going into 2026, you could see a very exciting new revenue stream just at the time when institutions are getting the green light.
Mark, so I know you have a buy on this name, you're a believer, but when you're talking to your clients, Mark, and they say, okay, it's a buy, but what are the downside risks I need to consider? You say what, Mark?
I think there are a few things. I mean, just today, we saw that in the U.S. Senate, one of the two versions of the stablecoin bill was voted down by a single vote. It was 49-48. And ultimately, there's probably going to be some more horse trading that occurs before that story is over. But if we don't see that legislation passed that would enable the institutions to feel more comfortable, then this is still very much a retail space. Retail investors, as we've seen, are somewhat fickle as it pertains to crypto. And that translates into an awful lot of volatility. Volatility in the stock market translates into a lower multiple, typically speaking. This is why Coinbase is so focused on that subscription and services line. The more recurring revenue that is part of the story, the fuller the multiple on the stock should be, the better the stock should perform.
Oscar Health, an insurance technology company, soaring over the last 2 days after topping earnings estimates on the top and bottom line. Joining us now, Mark Bertolini, Oscar Health CEO, to break down the numbers, as well as our healthcare reporter, Anjali Kemlani. Mark, thank you so much for being with us. It is fantastic to see you, first of all. And your numbers, really interesting. In particular, I saw a lot of commentary around your costs being better than estimated. So first, I just wanted to kick us off with you telling us a little bit about that, how you sort of got costs down to beat the street and what contributed to that.
Well, there are two pieces to it. One is the leverage of growth. So we've grown since I joined by almost 1 million members in the last 2 years. So that's part one. But part two is that we have been using large language models for a number of years now. Our founders have a relationship with OpenAI. Josh Kushner, who's one of our founders, actually was one of the first investors in OpenAI. And so we've been using these models. And prior to this year, we had implemented 20 large language models, and then we're implementing 10 so far this year, where we have reduced our operating costs by 1,660 basis points.
Mark, it's Anjali here. Really good to see you again. Talk to me about that and how Oscar is really doing this, in a field where you're competing with some of the larger insurers. I know, there aren't as many competing in the ACA marketplace as before, but you have been focusing a lot on technology. Oscar's reputation started there. So how does what Oscar is doing, is it scalable? Is it something that we can see, some of these large vertically integrated organizations kind of mimic, considering that they are struggling with costs right now?
Well, Anjali, the biggest part about implementing AI at scale is that you have to have a single version of the truth in the data set. And so Oscar, by its history, is the first new health insurance platform to be built in the industry since 1972, and we have a single source of truth on the data. So we don't have multiple versions of Mark Bertolini running around, thank God. And so the whole idea is if we have a single version of the truth, we can use that data effectively. Now, we didn't start on the clinical side right away. We started in the back office, and we started on things like making information available for members. So in 2024, in January, we grew by 600,000 lives. We did that with 200 less people and better service standards than we did the year before when we grew by 100,000 lives. So the model is what can we do to get people information more quickly? How can we support our brokers in enrolling members into our plan? All of those sort of backroom kind of things that make it simpler and easier to do business with us. This year, we've implemented some interesting models. We have one that intakes people and gets us a sense of their conditions that they want to address and allows us then to provide support through our virtual medical group to help them get that care. The other is sort of what I would call a symptom checker. So think of back in the day, WebMD and others coming forward with all this online information. We now have a chat bot that allows you to take you through the symptom checker in a way to say, okay, what do I do next? What do I need to do? What do I need to understand?
Fair. And I know you and I have talked a lot about, how insurers are operating, how the entire industry really needs an overhaul. And this is just an example of that. I want to talk about also, we saw your former place exit the ACA marketplace. And I know you're focusing a lot more on ICHRA right now, but talk to me about what that does really for the entire marketplace and what that means for members and their, what's available for them.
Anjali, one of the interesting things that is I've worked here for the last couple of years and understood the way people buy a couple of important things. The more players in the market, the better. In large part because everybody has narrow networks in the Affordable Care Act. And narrow networks allow you to get a lower price point because you're moving revenue to fewer players and they get share as a result. That is counterintuitive to what we do in the employer market, where you have large numbers of employees and you have large networks, which actually have higher cost points. So if you have more players and they all have narrow networks, and currently today, 75% of physicians in the US are in the Affordable Care Act networks somewhere. If I'm a buyer, instead of me having to buy what my employer offers me, I can buy at a better price point as an individual in the individual market because I can find my network with my plan design that works for me. The plan design is important because it's about my risk and what I need to cover, whereas with an employer, they pick an average down the middle for their employees, and nobody likes to be considered to be average, but we have fewer solutions to pick from. And given that in the ACA now, 95% of all enrollment growth comes through a broker, brokers are helping us get people into the right plans. So that's why the individual market works better from a cost point. That's why the more players in, the better, because we have access to the providers that anybody needs. So our view is we don't need to get all the members. We want the members that need our products and our networks. We want to serve them well at a price point that for the last 3 years has been below or at the cost of inflation.
Mark, I want to ask you beyond Oscar, though, because obviously, as Anjali mentioned, you're a veteran of the industry. You led Aetna for more than a decade, or you were at Aetna for more than a decade. It feels like to many, at least for many patients, they feel like the system is broken, right? They're not happy with it. This is not new. We've seen it bubble up in new and dangerous ways over the past year or so. What do you think is sort of the biggest issue there? What's the biggest challenge? What needs to be fixed the most?
I think it's so we've moved healthcare beyond population health and beyond disease management to individual health. And individual health means I need to have my provider that I use, and I need to have my product that works best for me. Those are the important things for me as a member. So if I can find my doctor in a plan design that allows me to cover what I need to get covered, instead of what my employer buys for me, which isn't bought all that cost effectively, versus what can happen in the individual market, I'm better off. So a lot of the things members complain about is prior authorizations, or all the things that, if I know what my concerns are for my health, I know what I need, why am I having to go through the insurance company to get it approved? So there are products that are now being launched that allow people to have frictionless care. And those frictionless care models allow me to get what I need on my terms at my cost. And that's what, everywhere else in our economy, we can get that. In healthcare, we can't. Somebody else buys it for me and tells me, here, you have to use it. And oh, by the way, I want you to pay 15% of the premium.
Yeah, that sounds like a good summary of what people don't like about it. Mark, we got to leave it there, unfortunately.
Why is this so hard?
We always love talking to you. So come back again and talk to us soon. And thanks, of course, to Anjali as well.
Disney shares are on the move after topping second quarter expectations and raising its full year outlook, citing strong performances from its theme parks and streaming business. The company adding 1.4 million Disney Plus subscribers in the quarter, bringing the total number of subscribers to 126 million. Joining us now, we've got Geeta Ranganathan, who is the Bloomberg Intelligence Senior Media Analyst. Geeta, great to have you back here with us. I just want to get your read in on these results.
Thank you, Brad. So this was really, A+ for Disney in terms of execution. So such strong momentum across all businesses, especially as you pointed out, both at the theme parks business. Remember, theme parks makes up about 55 to 60% of Disney's operating income. So extremely, extremely important to the company in the context of overall results. And also it's, so sensitive to the overall, macro trends as well as to consumer sentiment. So for them to come out and raise EPS guidance, this was supposed to grow high single digits. Now they've raised it to 16% growth, is really telling. And then, of course, streaming as well. Yes, Maddie.
Thank you, Geeta. Sorry about that. I do want to talk more about the streaming, but in terms of the price action, I'm just curious, do you think that this is a little bit too optimistic with the stock over 9% up right now, given that it's still down 50% from its prior peak?
I don't think it's too optimistic. So they did, they have a very good growth outlook. And I think why that has managed to dispel so many fears is because, we were really kind of expecting this overall consumer slowdown to have a pretty significant impact on the outlook for Disney's parks. And, they kind of come out swinging and point to advanced bookings being up pretty substantially, both in fiscal third quarter as well as fiscal fourth quarter. And that's just not the macro economy. Remember, we also have a major competitor in Comcast's Epic Universe, which is just opening in a few weeks in Florida. And that's supposed to be a source of major competition. And for them to come out and give such a strong forecast, just points to the confidence the management team has and really kind of raises investor confidence across the board.
I guess another facet to this, too, is how Disney is gauging the interest and the demand for parks internationally, especially with the announcement this morning about extending the company's global reach, captivating new audiences with the 7th Disney destination. That's going to be targeting Abu Dhabi. So all of that in mind here, how do we get a kind of broader read on, or how investors should be grading Disney on bringing some of these new parks experiences to life over the long term?
Yeah, I think parks has really been such an underappreciated part of the business, Brad. And I think now investors are really going to be forced to pay attention. They have fantastic IP, they have a world-class brand, and the amount of investments that they're undertaking in that business, there's $60 billion that they've committed to grow capacity in the parks, to increase the number of attractions across all of these different properties. And then you have them adding this 7th new destination in Abu Dhabi. They already have about 120 million visitors to their parks every year. Expect that to now rise pretty substantially with this new park that's going to come on board. And then you have them making really huge investments in their cruise ships. So remember, they just added their 6th cruise ship, and they're basically going to double their fleet capacity over the next 5 to 10 years. So again, we're looking at them basically doubling or maybe even tripling their cruise revenue. So across the board, again, with the theme park segment itself, we're seeing tremendous strength in the domestic parks. And then, of course, they're adding capacity, building out the footprint, and then doubling down on cruises.
Geetha, talk to me about the bigger competition or threat to the narrative you just pointed out. Is it the likes of a competitor through Universal with Universal Epic, or is it just an uncertain macro environment that could potentially lead to a slowdown in growth that could weigh on people spending money on experiences like the ones you just laid out?
Yeah, I mean, that is always going to be a concern, Maddie, with the theme park business just being so sensitive to consumer sentiment. But what we've seen so far is, the consumer is still spending, at least domestically. We're not seeing any signs of a slowdown just yet. Having said that, though, they did point out a slowing consumer in China. So if you just look at their international parks results for the fiscal second quarter that they just reported, they actually reported, a decline in operating income in the international parks, and that was because of the slowdown in Chinese per capita spending. So that is obviously always a risk. But if you just kind of look at the big picture, yes, we've had pockets where, they've had a slowdown with a recession, with COVID. But then if you just look at COVID, I mean, Disney basically came back stronger than ever. They in 2022, they just reported such a massive surge, in theme park attendance, in theme park revenue. And then with all of the operational efficiencies that they have kind of implemented over the past few years, we're seeing tremendous momentum in terms of operating leverage. We're seeing returns and operating margins being stronger than ever. And that's basically what they're kind of really focusing on over the next few years.
Geetha, just lastly, while we have you here, the direct-to-consumer entertainment segment here for Disney, this has been a massive area of contention, especially among activist investors over the past few quarters. We've seen some of those campaigns subside here. Do the results here in this quarter and the outlook going forward give enough to really kind of quell some of the concerns around their direct-to-consumer and specifically their streaming business?
Absolutely, Brad. So, we just saw them report for the first half of fiscal 2025 about $629 million in operating income just for the streaming unit. Remember, just a few years ago, this was a unit that was posting something like $4 billion in streaming losses. So this year, we're going to see, about $1 billion or more in operating income. But it's not about this year. It's about where this business goes over the next few years. If you just look at Netflix as a comparison, I mean, Netflix is guiding to something like 30% operating margin. Disney has 4% operating margin this year, potentially, but just look at where that could potentially go, right? We're looking at them potentially tripling, quadrupling, profits in that segment. So again, huge amount of upside, especially with their upcoming ESPN streaming launch a little bit later this year.
Geetha, great to see you this morning. Thanks so much for taking the time.
Thank you.
AMD's first quarter results, they are just hitting the wire. Let's take a look at those numbers. Shares up about 7% initially in the after hours. Q1 adjusted EPS 96 cents versus the estimate of 94 cents. So that's a beat on the bottom line. Revenue $7.44 billion. The street was at $7.12 billion. So beats on the bottom and the top. Just looking at Q2 revenue, what they're calling for between 7.1 and 7.7 billion. The street was closer to 7.23 billion. And they are modeling Q2 adjusted gross margins 43%, and they say that it is inclusive of export charges. Remember, the stock was under some pressure here. Of course, it was down year to date about 20% heading into this print. It was down nearly 40% over the past 12 months. We're higher here in the after hours. Big picture questions, obviously. How does AMD talk about the AI opportunity ahead? Any more color and commentary around the Trump tariffs and their impact on this company's bottom line? Computers we know exempt from Trump tariffs, but the administration saying could impose duties on semiconductors. China angle, AMD in April, remember, talking about this Trump administration instituting tighter export controls, so you can be sure there'll be more questions about that as well. And of course, always more color and commentary about the PC market, how that they see that evolving over 2025 shipments ahead. We'll stay on it. Well, AMD reporting a revenue beat for the first quarter, along with upbeat second quarter revenue guidance. Synovus Trust Senior Portfolio Manager Daniel Morgan joins us now to discuss. Dan, it is always good to see you. So I got AMD up. We were up nearly 5% in the after hours, Dan. Dan. Strong revenue forecast for Q2. They're looking for sales of about $7.4 billion. That does beat consensus. But what did you make of the report, Dan? Give us your initial take here.
Well, it's interesting, Josh. Of course, you already reported, revenue was a beat. In terms of earnings were a beat. You mentioned the guide for the upcoming second quarter. I think the street was looking for $7.23 billion. They did 7.4 plus or minus 300 million, which puts them above the midpoint. The numbers that really stood out to me, data center came in above estimates at 3.7 billion. That was up about 57%. But client compute estimate was a little over 2 billion. They came at 2.3 billion, up 68%. So it looks like, Josh, there were a lot of worries coming into this quarter that data center would slow down in terms of the acceleration and growth, but they would make it up in client computing, and it looks like they have. They've had a lot of success with their Ryzen chip, which goes into PCs, and I think that helped them get that boost because we actually saw an acceleration in the client compute area, up 68% compared to what we saw in the fourth quarter 24. So that was very encouraging.
So in that client compute group, Dan, as you try to think through, the health and resilience of the PC market over 2025, what does it look like to you?
IDC's got an estimate right now of 5% growth. And a lot of that is based on people buying ahead of the tariffs, right? Mm-hmm. Even though PCs and smartphones have been exempt, there's still worries that will be lifted and eventually you'll start to get a ramp up in terms of tariffs. So I think that's what's kind of being built into that number right now. Again, Josh, nothing compared to what we saw during the work from home COVID time period where we saw a huge increase in demand for PCs and laptops. We've gone back to our more normalized, mature growth rate that we've had, the last 10 or 15 years, which is kind of mid to single digit.
What is, Dan, the kind of long-term AI opportunity for AMD as it competes with NVIDIA? How do you think about that and frame it?
Well, Josh, it's interesting because on the last quarter, which was the fourth quarter of 24, management came out and said that they expect the data center group, which is where the AI chips are housed, growth to be flat versus the first quarter or first half of the year of 25. But they said once we start ramping up on this new MI325X, MI350X chips, we're expecting a big push in growth in the second half of 25. So, Josh, as you know, you and I have talked many times about NVIDIA. They have the new Blackwell chip that's coming out. So that MI325X, MI350X for AMD are going to go head to head against the Blackwell ramp. So stay tuned.
Now in April, Dan, AMD did say we expected to record this expense, about $800 million, after our government, imposes more restrictions on these chip exports to China. How should investors be thinking through what that means for AMD, near term, long term?
You're right, Josh. They came out and announced $800 million write-off on inventory for their MI308 chip because of, like you said, because of the Chinese restrictions. They're not going to be able to ship that chip out. And obviously that hurts. They did about $5 billion in the MI300 AI chip series last year in revenue. So you can do the math. It's pretty sizable, almost 20% of what they did, they had to write off. And this is a concern, Josh, going forward, because how do they make that up, right? They've got to make it up with revenues coming from another chip. And then going forward, can we expect any future charge-offs that we just don't know about because we don't know what the retaliatory environment's going to be in terms of restrictions from China? So that's kind of a wild card moving into this rollout in the second half of the year for these new AI chips that they have.
Bottom line, Dan, correct me if I'm wrong, my friend, but do you own NVIDIA but not AMD?
You know what? We own all three of the big AI chip makers. So we have a massive position in NVIDIA, as you know, because I've been on with you a couple times to talk about it. Yep. We own Broadcom, which has been really very successful for us. And we also own AMD. And those are our three plays. Okay. We don't own Marvel. That would be the other option in the peer group. But we have those three as kind of being our leadership players in terms of AI chips.
Last question, Dan, quickly. Do you own Intel as well?
We own Intel, but as you know, they've been delayed on their new chips coming out in the AI space, and they haven't really been in the mix. So I still consider them a CPU player until they can come out with a bona fide GPU that can take on Blackwell.
Dan, always great to see you. Always great to have you on the show. Thank you, sir.
Thank you.